Good afternoon, good morning, good evening. Welcome, everyone. Great to have you joining us today. This is one of our series of IIED debates looking at key issues that are affecting global and environmental environment at this time. We have a great panel today. We have a couple of them still joining, but we're hoping to get underway shortly. In terms of the format, we'll be asking questions of our panelists, and then we really want to get a debate going. So please do ask questions in the Q&A function. Also in the chat, we really encourage those joining to share who they are and where they're coming from. We won't have time to have everybody introduce themselves, but to give that opportunity for those of us who are online to share the way that you might do. If you're actually in a room with somebody, you might pick up some interesting and useful contacts. Let me kick off then by repeating my welcome to everyone and just setting the context of what we're going to be talking about today. In 2 weeks' time, the IMF and World Bank spring meetings will be starting in Washington. And then in June, we'll have the 4th International Conference on Financing for Development. So these are key issues or key opportunities for the issues around international financial architecture reform to be discussed and debated, and to find solutions to the challenges that low-income countries are still facing with unsustainable debt burdens and how to unlock finance for climate and nature. Many of the countries that are affected by these crises are also having challenges with their shorter and longer term development needs. So we really want to take a holistic view of these issues. So we've got a panel today who will discuss some of the innovative solutions and policy recommendations that we need to build a fairer and more resilient global financial system, and also ways that we can work together. This isn't something that governments can solve, the financial institutions, or the private sector. We need collaborative ways of working. And we're very pleased to have a panel with experience across all of those areas. We'll be starting with Dr. Mahmoud, who is United Nations Special Envoy for Financing for the 2030 Agenda. We have Annika Otterstedt, who's from CEDA, a leader in finance for development and supporting work to get private sector engagement. We also have Sonja Gibbs from the Institute for International Finance. Sonja works a lot with private sector actors in this space. And then Jwala Rambarran, who is with the Caribbean Policy Development Center, working very much on debt relief efforts and debt solutions that will really help to drive resources to the local level and finding solutions that will address the key challenges these countries are facing. So we've got a set of questions for our panelists. So I'd like to start off by asking those panelists to come in, and then we'll have around about 20 minutes at the end for discussion. So as I've said, please do start as we go along, putting your questions into the Q&A box, and you'll see it's at the bottom of the screen at the right hand side. We have got people checking the chat as well, so if you accidentally put your question in there, we'll still try to pick it up, but please do try and put your question into the Q&A box. And so without further ado, Mahmoud, can I ask you to start us off with what you see as some of the biggest challenges that we face with the financial architecture system, and how debt reform can be leveraged to unlock finance?
Right. Thank you so much, Laura, for having me. And it's a great pleasure and honor to join you with the esteemed panelists. So let me just put matters related to that in the context of the preparation of the Finance for Development conference in Seville. And as we know, following up on the discussions that the global community had since Monterey, then Doha, then Addis, when we mobilize finance, we are talking about all sources of funding, domestic, external, public, private. Debt management is included in that, in addition to trade, investment in STI, science, technology, and innovation, and dealing with what's so-called systemic issues, which includes the international financial architecture. This is basically the building blocks of the finance for development in few seconds, but we need to look into them as a system. You cannot compromise one part and assume that the other parts could really take over or complement. So the impact for instance, of declining ODA, not just in relative terms, but in absolute terms, even if you are very much interested in pushing the private sector to do a better job, the private sector may need blended finance, may need de-risking, may need leveraging, may need technical assistance, project preparations. This is all very much dependent on concessional finance and ODA. So even if you are assuming that the private sector can do a better job, this better job could be compromised by declining ODA. We say, well, do a better job at DRM, domestic resource mobilization. Again, you may need technical assistance and support from the likes of the World Bank or the IMF to help these countries with lower tax revenue to GDP or lower public revenue mobilization than the optimal, to have at least some knowledge sharing and technical assistance. These kind of sources are very much important. They come in kind, they come in cash and support. In addition to that, as we know, some low-income countries are heavily dependent on ODA, on official development assistance, to the extent that some countries, like our brothers in South Sudan, their budget is almost 50% dependent on ODA. So in all of that, we need really to put the context of debt. Debt is a puzzling issue now. We have countries defaulting. The submitted request for restructuring to the common framework mechanism, which has been slow from the very beginning, leaves a lot to be desired in terms of speed, in terms of including the middle income countries as well. But we know that there are few countries that have been seeking help for quite some time. But what is worse than default, with the cost of default, including a denial of access to the markets, if the countries that didn't default on their repayments of debt by defaulting almost in everything else, by reducing what they spend on education or in health or in essential services. So it's very much a case now that we see it is a kind of a silent debt crisis, as my good friends from the World Bank, my old good colleagues, called it the silent debt crisis, because some of the borrowers, including those who are in distress or in need of restructuring of their debt or declaring default, are shying away from that because of the cost of defaulting. But there is a bigger cost for development, for long-term investment, that somebody has really to calculate. And many actually are doing that by comparing the amount that we are paying in interest cost compared to what we spend on education, health, and essential services put together. So it remains for development finance, nature finance, and climate finance, what I've been sharing since the preparation of the COP27 in Sharm el-Sheikh back in the day, 2022, perceived now as if it's decades ago, though it's just a couple of years ago, but many things happened since, that finance for development, climate, and nature remains insufficient because of the gaps of funding, inefficient because of the time it takes until you get a dollar out from the financial institutions, and unfair because of the cost of borrowing. And it's good that the G20 has now a group looking into this issue of the cost of capital and cost of borrowing. In few seconds, can I just tell you on what we are doing as a group asked by the Secretary General to provide some solutions for debt. And this group includes Trevor Manuel, the formidable former Minister of Finance of South Africa, former Prime Minister Paolo Gentiloni, who's been a commissioner with the EU as well, and Professor Yang Wang of University of Boston. We're trying to get not a new report done, because many colleagues, including Sonja and others on the call, know that there are many reports, many initiatives on debt. What we're trying to do is basically bridging all of these kind of reports and getting them operationalized, implemented. So are not just checking what's technically feasible, which is almost all initiatives from the Bridgetown Initiative to the Paris Pact to the calls coming from Nairobi for climate finance. All of these are interesting and technically feasible, well studied, supported by great scholars, and beyond experiments of their ideas, they are feasible. But what's lacking is the political leadership. So what we're trying to do, this could be subject to criticism because we have to lower some of the expectations, not just technically feasible, but politically feasible. We are trying to do the following. First, to distinguish between liquidity challenges and insolvency as a crisis. And then the other thing is basically how can we deal with all of that in the new environment of ODA? Because there are many of these old solutions had more than generous assumptions about not just continuity of ODA, but increased ODA. The third thing is basically about the debt sustainability analysis for low-income countries, which is under review now by the IMF and the World Bank, who are encouraging more rigorous review, more comprehensive review, not just for the low-income countries, but for countries with market access as well. And there are many suggestions that we are considering, including different consideration for long-term finance, the role of domestic capital markets, and issues related to critical indicators for debt. Then we are happy to support the three-pillar approach of the IMF and the World Bank, which is basically about putting the house in order, enhance the role of the IFIs, and do better job in debt reduction mechanisms. They proposed that jointly, the IMF and the World Bank, back in August. I hope that they still can implement what they intended. We are fully behind them if they can do it. And then there are some existing tools, including lending into arrears by the IMF, that could be used better, especially with the private sector, to incentivize them to do the needed for during debt restructuring. And there is a debt relief trust fund at the World Bank that needs to be enhanced in its resources. Middle-income countries, as I hinted, needs to be included in the common framework of the G20, and it needs really to borrow some good ideas of speed. Then what we need to have as well is basically more of scale when it comes to debt swaps mechanisms. We have seen some good experiments in debt swaps for nature, for climate. Now, given that the IMF is saying, well, it's not a bad idea if you link it better to the macroeconomic reforms. Yes, we agree with that, but we need to have it more at scale. Then another a good look to the domestic markets. We need to push more on the role of the local currencies market, but not to look at them as if they are panacea, because they come with their own risks if you are not handling better issues related to the carry trade. There is a lot of needs as well for capacity building. And finally, there is a good idea that it needs to be entertained. While there are many forums, many clubs for commercial banks, international financial institutions, the private sector ones. Some of them are hosted by the IIF. There is the Paris Club, there is the London Club, but actually the borrowers have no forum or club. So we are supporting the idea of having a borrowers club, not just for the desperate cases, but actually for all credits, for them to share knowledge, to provide technical assistance, and could really coordinate between them better vis-a-vis their creditors. And finally, with the blessings, this is the final, with the blessings, literally, of the Pope and the support of the Grand Imam of Al-Azhar, there is a Jubilee initiative, as we know, about debt relief, reminding us of the good old days of HEPIC. So the Pope is supporting a Jubilee initiative. We are fully behind it, and it's good as well that other faith leaders, including the Grand Imam of Al-Azhar, is fully behind it as well. So this is basically, we are trying to get all solutions from public, private, and even from the faith leaders to solve this big problem, which we need to call it by its name. It's a crisis for many countries. Thank you.
Thank you, Mahmoud. That's great. And I mean, the amount of work that you're doing and that you always do, I mean, you've given us a huge agenda there. But as you say, it's about people coming together. And I think many of the issues you've covered will pick up with some of our other speakers. So I'd now like to turn to Annika. Coming from CEDA, obviously ODA is important, as Mahmoud has said, but we are in a time of challenges with domestic budgets. So it's also about making aid work more effectively. So could you tell us something about the principles of effective development cooperation and some of the ways that aid can be used better, and some of how the how debt reform can link up to some of those principles? Thank you.
Yes, thank you. I think I'll try to speak a little bit about the development effectiveness agenda, but also about how can we then improve development cooperation in practical terms and in relation to nature and environment, climate change. I think all of us know that, and all experiences show us that the more development cooperation is, I mean, on one hand, aligned with the partner country's own priorities, the development agenda of that country, of course, the more likely there will be efficient and effective development in that country, even though we might not agree on every single detail of the development plan. I also think that the challenge today is that, of course, on one hand, the donor countries, they know that the more we coordinate ourselves in our contributions and in our development partnership with any country or any region, the better the results will be. But there is also an increasing, I think, interest from our part of the world to see results in terms of, our own taxpayers' money or the funding. So we want to see what precisely is every single Swedish crown doing in a certain context, which is a bit difficult when we all at the same time, we understand that, but we also know that it is also good to work with, in the multilateral system with other organizations, both with other bilateral partners, but also within the multilateral systems to ensure that we all use the same principles when it comes to alignment and the way we present and report back results, and that we try to do it in a very coordinated and effective way in terms of the donor country's perspective. And that this is not, I think that is, this is one of the major challenges now, that the funding gap is increasing between where we are and the likelihood of reaching the Agenda 2030 objectives, at the same time as we have humanitarian needs that are steadily increasing. And in the light of what's happening across the Atlantic Sea, they will continue to, that gap will continue to increase. So I think another challenge that we have today is that how do we maintain the development effectiveness architecture, which was built, I mean, in Paris, in Lausanne, at the same time as the available funding from development cooperation as such is decreasing. And now, of course, everybody's trying to attract external capital from the private sector to add to that development funding. But that, of course, also implies that the funding will then come from other sectors, other other countries or the industry, which might have a different perspective on development effectiveness than we as more traditional donors have and have agreed upon together with our partner countries. So I think that will be a challenging theme in Sevilla in June in the Finance for Development conference. I also think that the pressure that a lot of governments have in Europe and in some other parts of the world in proving to our public that development cooperation is effective, puts a lot of pressure on the system in both a good and perhaps a challenging way. But it requires us to link up more with the private sector. And I think what we need to do there is to ensure, I mean, if we want to succeed with contributing to sustainable development within each country's own sort of budget framework, we also need to ensure that we do support sustainable initiatives when cooperating with the private sector or with foundations or with even with the civil society, but that is more obvious. So I think I used to be working in Kenya and came back in December, and all these topics were very high on the political agenda when Kenya almost defaulted last year. And of course, and I think, you know, we need to look at two different perspectives. One is, of course, why is there such a heavy debt burden in a country such as Kenya, as an example, where you have, you know, a lot of natural resources, heavily dependent on natural resources, both for its agricultural production and its tourism sector, and two of the most, perhaps the two most important economic sectors in that country. So how come then, why do you have such a high debt burden? And how do we, in our dialogue with Kenya, the Kenyan government as an example, how do we make sure then that there is a joint interest in from both sides to align with global principles for transparency, results for everyone, meaning that there should be a decrease in the gap between the richest and the poorest groups in that country, I believe. And then at the same time trying to coordinate both within the donor group and within the government of Kenya, as well as other parties. But that will require that, of course, and this is a bit, I mean, it's always very sensitive, the procurement processes in any country, they need to be also based upon principles that, you know, if the recipient countries expect the donor countries to support them with debt reliefs, I think the donor countries will also expect the recipient countries to then have a very, you know, a procurement process which is more transparent, which is also built upon more sustainable principles aligned with the Agenda 2030 agenda, which is also more transparent to its own people, to avoid that any country has a high debt burden, which is on one hand not, you know, not approved of by its people, and it's not improving the sustainability of the economic development of that country, implying that future costs of that debt burden will not only be financial, with a heavy burden on future generations, but also a heavy burden in pure nature conservancy or environment, climate, you know, that perspective. So, and I think, so that is a discussion that is important to have when linking it to natural resources, environment, and climate change. Then on the other hand, of course, and there are many initiatives that would at the same time improve the financing of the sustainable use of natural resources, for example, forest areas or agricultural landscapes or nature conservancies in East Africa, for example, which could then lead to financing, for example, in terms of carbon or biocredits, which is, of course, which then also requires support, technical support in building up a system which is transparent and where you can verify where, you know, how the money is used, and also that the financing system is built upon transparent principles and that local people have been engaged and so forth. So I think there are lots of opportunities, which is then, you know, in a way linking both traditional development cooperation to the private sector, but also to the government institutions. Of course, every country needs functioning government systems, functioning government institutions to maintain order and also to execute government politics. But you also need to have a vivid civil society as a watchdog, and both in terms of the government and the private sector, of course. So I think that's where development funding and development, the donor community can play a very important role. And we can also, I think, play a role when it comes to supporting any country in perhaps acquiring more knowledge in terms of how does any country do a procurement, the terms of references to any procurement which would have a major impact on the debt burden, for example, on a large scale infrastructure project. That is where we can give that support. We can work together with the government institutions. We can also work together with the private sector and the banks in for example, supporting technical advice, technical advisory platforms, both for the banks or the lenders, but also for the borrowers, so that any party who is borrowing money, be it the government or any private an enterprise or a farmer, they would also receive that or be engaged in capacity development to understand the implications of borrowing or using funds which is used for the purpose of creating a sustainable society with sustainable services versus not creating sustainable services or a sustainable infrastructure. So I think that from our perspective, it's of course important to, on one hand, ensure that debt is not created, is not recreated all the time for spending and for investments in a non-sustainable development, because that is saying that future generations will not only have a debt burden to pay off, but also they will be in a less good situation, and the cost of living will increase in all different perspectives. I think that is the responsibility we have. Then on the other hand, if they're already, we already have a debt, we have increasing debts, and the people that we primarily work with and for have not caused that debt. So how do we then, as donor countries, ensure that we on our side also speak to banks, financial institutions, and using the global platforms for dialogue to ensure that we do try to not lend money to governments or for purposes that are not sustainable in the long run, and that we perhaps we could increase the support to decreasing the interest rate in borrowing in order to perhaps support the countries to borrow from those countries or those financial institutions that combine lending with technical assistance or have a long-term plan for how that money should be used in a beneficial way to the country and its people. And I think that's where we have one, a big responsibility. But then, of course, we cannot have an impact on some other countries lending, but we can have a constant dialogue, and also I think put some pressure on some of the partner governments to, because of what's happening in the world now, and because there are increased requirements from our taxpayers, perhaps that could be an incentive for the recipient governments to think twice before they invest in a private sector which is not linked to any sort of additional benefits for the people of that country. Thank you.
Thank you, Annika. I think you make this very important point about accountability and accountability to citizens and to the public, both in donor countries, it's taxpayers' money, but very importantly in the developing countries themselves. Jwala, you've got a wealth of experience in this area. Can you share some insights with us on what are some of the sort of the locally led ways that we can look at sort of debt reform, that's particularly the small island developing states that you've had experience in? Thank you.
Yeah, sure. Thanks, Laura, and thanks for the invite to this very informative webinar and with some really fantastic colleagues. I'll answer your question by reference to the Caribbean region, to the Caribbean SIDS. And these are countries that are really struggling at the moment with what we call this climate debt nexus. So in some cases, It's called the climate sovereign debt doom loop. Because as you know, Caribbean SIDS are actually amongst the most heavily indebted SIDS worldwide. The average debt to GDP ratio for the region is now somewhere at about 75% of GDP. And that number, of course, masks some disparities. You have a few countries where debt is really over 100%, and then you have some where debt is really low. And those are some of the countries that actually went through the HIPC initiative. But what has happened over the years is that the creditor profile has become very diverse. So we now have to look at creditors like how you engage China, the multilateral development banks, and the private creditors have also, their share in external debt has risen considerably. Now, a good part of this debt can be traced to climate shocks, primarily how Caribbean countries have had to respond to financing the loss and damages that come from the impact of tropical storms and hurricanes. Just last year, we had Hurricane Beryl passing through the region, and you now have countries like St. Vincent and the Grenadines and Grenada having to deal with loss and damages of just around 20% of GDP in 1 year. But we've also been a region where we've seen overnight one country lose more than twice its GDP from one event, and that's Dominica in 2017 when Hurricane Maria hit, and those loss and damages amounted to over 225% of GDP. So it is a tremendous burden for Caribbean countries in terms of this particular climate debt nexus that they face. And at the same time, it is a country rich in biodiversity, substantial marine spaces, coral reefs, mangroves, seagrass beds. But this vast natural capital is something that the region hasn't really looked at. How do you unlock that in the context of this high debt profile? Now, that's not that we haven't looked at a number of different solutions. The Caribbean actually pioneered debt pause clauses. Grenada was actually the first to do that a decade ago. And that is now entered into the global discussion as climate resilient debt clauses that were pushed by Prime Minister Motley of Barbados. But what I want to really just focus on more is around the work that the Caribbean has done on debt for climate swaps, because Mahmoud mentioned that, because these have re-emerged as a more promising financial solution. There are a number of issues, of course, with them that I think would need to be taken into account. But that doesn't mean that as particular financial instruments, they have not delivered. They have actually been able to do that despite, I would say, over-promising in particular areas. Yeah. If we look at Barbados, just late last year, Barbados undertook what it called the world's first debt for climate resilience swap. And that was really to address the issues of water scarcity in Barbados, which is one of the world's most water-stressed countries. Barbados was able to buy back about $300 million of existing debt and replace that with a sustainability-linked loan. And a good part of this funding was actually provided by private banks. And this structure, this deal, took place within the context of Barbados being under the IMF's Resilience and Sustainability Fund. And a key part of that fund is how do you catalyze private climate finance? And really, it took 2 years for Barbados to finally reach that point where the private sector could come to the table to deliver climate finance. And I think so there are some lessons in terms of how that was done for other SIDS. We also have the case of Bahamas, which late last year also launched a nature bonds project. And that project is to also refinance about $300 million worth of debt. And put that into improving conservation and management of the marine protected areas. If you know, Bahamas is actually one of those countries that has a tremendous natural capital when it comes to its seagrasses. And therefore, it is looking at how then do we unlock the value of that natural asset through blue finance to undertake the type of conservation that's needed, but also to see how you could reduce some of the debt service that the country is facing. Again, what was key with this particular debt swap is that Bahamas was able to bring a private investor in, right? That was able to provide a co-guarantee alongside a multilateral development bank. And again, that points to the role of what Mahmoud was speaking to in terms of when we start to look at blended finance, we need to look at some innovative structures where MDBs could take some sort of, provide the sort of guarantee structure that's needed to allow for private sector to come into the space. Same thing in Bahamas, they were able to bring a private insurer in to provide credit insurance, thereby reducing overall the political risk associated with the project and also the cost of capital. And I think these are the sort of innovations that we started to see in the Caribbean that says we could use this and build on this to get all the major stakeholders in. So from government, possibly taking, let's say, a first loss position on one of these deals, to MDBs coming in and providing the kind of guarantees that would then allow private sector to come into the capital market deal to do the sort of financing that's needed, and where the overall cost of the project, that capital cost now falls and it becomes even more attractive to private sector players. Now, a lot of what we've seen recently in Barbados and Bahamas and other Caribbean countries are looking at some of these debt swaps. They actually were catalyzed by what we saw happening with Belize when it did that first commercial debt swap. And Belize was actually the first country that was able to really get a debt stock reduction, net of debt service reduction when it did that, simply because it had already defaulted on its super bond. Right? And I think that set the stage for other countries starting to look at, could we do this, and could we do this in a better way, bringing in the private sector. Now, there are a few other instruments that, as I've said, Caribbean countries have looked at in terms of how you address this debt climate nexus. Climate resilient debt clauses are one. Parametric insurance for sovereign debt is another. This is a region that actually created the first regional catastrophe risk pool in the form of what we call CRIF. And CRIF has been able to provide some of the sort of funding for governments when these disasters hit. But there's need to also raise the capacity of CRIF to respond, because if you look at the payouts that are coming, the payouts are really small when you compare them to the loss and damages. And while we know that CRIF by itself cannot meet the full loss and damage costs, there is need to raise that capacity. And then how then, as a regional risk player, do you then even create a sort of regional reinsurance pool, given that reinsurance rates are rising due to the amount of disasters? So these are some of the things, the sort of innovation that the Caribbean is looking at, based on some of the initiatives too that Mahmoud spoke to, and seeing then how could we really deal with this climate debt nexus that we're faced with. So I'll pause here.
Thank you, Jwala. Really, really good to get that local perspective, and to encourage people to put their questions in the chat. I just noticed that one was asked about reinsurance just before you mentioned it there. So, we can see that there are these themes that are coming through very, very strongly in what we're talking about today. And it's now very nice to move on to Sonja from the Institute for International Finance, who works very much as a body of private sector investors. Sonja, we've heard from all of our speakers potentially around the role of the private sector, but over to you to hear what role you see the private sector as playing in these sorts of reform efforts, swaps, credit ratings, reinsurance, and so on. Thank you.
Thank you so much for the invitation to speak here today. At this time when policy uncertainty globally is so high, this type of discussion is particularly important. I want to stress, when you're thinking about things like reform efforts, the international financial architecture swaps and the credit ratings and so on, this whole concept of what we call a multi-pronged approach is critical, right? There are no silver bullets. We all know this. So we all need to work on this problem together. Governments, the development finance community, borrowing countries, and the private sector. So I just want to give a few perspectives on things like debt for nature swaps, credit rating agencies, and so on, broader solution set. So when you think about the international financial architecture and efforts to reform, none of this is new, right? We've been working on this for decades, whether it's making debt structuring fairer and more efficient, giving liquidity support during stress periods, or more broadly, ensuring a steady source of capital, external capital, for emerging and developing economies. I think one new twist is the growing participation and contributions of the private sector, including the work of the G20 IMF World Bank Global Sovereign Debt Roundtable. And Mahmoud alluded to this. The IIED is very pleased to be representing private creditors on this Global Sovereign Debt Roundtable. And it was encouraging. Just had a deputies meeting this morning of this Global Sovereign Debt Roundtable ahead of the spring meetings. Our plans to publish something that will be very useful, which is a debt structuring playbook, which is kind of like a guide for borrowing countries on best practices, how they go about debt structuring. So it will be incredibly useful. I think of other new factors to consider. I mean, we have the pain, these really escalating debt service burdens. We've got record levels combined with rising borrowing costs in this very uncertain environment. So that has to be factored into any efforts to mobilize private capital. You have much higher overall levels already. Then, of course, the other factor is what you might call sort of a guns versus butter trade-off, as economists refer to it. And that's particularly apparent in Europe with many more calls for defense spending. So it simply makes financing for other priorities, including climate and nature, that bit harder to come by. I think another factor that has to be considered in the efforts is what you might call neo-isolationism, particularly when it comes to withdrawal of donor aid, foreign assistance, and so on. Got to be factored into considerations. And, in many ways, what an effective withdrawal of U.S. perspectives from key international multilateral platforms like the G20 discussions. It's very hard to get clear perspectives on U.S. policy at the moment, even sitting here in Washington, D.C. So that just makes global solutions more complicated. I think we're clearly seeing, a retreat from long established international trade norms. And so we got a very, as you all know, high tariffs, market volatility related to that, and uncertainty about macro prospects, and it's particularly acute for some of the most vulnerable countries. All this to say we've higher structural market risk premium, and it's important to acknowledge that and find ways to deal with it. And it makes it more challenging to mobilize private finance, including for climate and nature goals. And this is the point that Jwala raised earlier. So I want to highlight here too the importance of blended finance type solutions, guarantees, and so on. And I want to stress that the international regulatory framework really needs to be more enabling in this context. So things like prudential regulatory barriers to development finance, including things like the treatment of MEB guarantees. We think these need to be more risk sensitive. We've got a paper out on this topic, which I will put a link to in the chat for people who want into the weeds on this complex and important subject. Also stresses the importance of having the right data available to properly evaluate levels of risk in emerging and developing economies so that investors can make better informed decisions. That's particularly important about these higher structural market risk premia that we have accurate data. I want to flag here the Global Emerging Markets database, the GEM database. There's a lot of very good granular information, which if we had better access to that, would be helpful in both investment decisions and in credit ratings analysis. So I want to turn quick to debt for nature swaps. There has been, of course, growing interest or renewed interest, you might say, in these instruments, and particularly in Africa. For example, the Sustainable Debt Coalition set up COP27. You've got the Sovereign Sustainability Debt Hub, the G20 under the Brazilian presidency and the South African presidency. Lots of interest in this in space. Tremendous potential benefits, but from a private sector perspective, there are some challenges as well, of course, particularly when it comes to the use of debt for nature swaps in debt restructuring. Part of it is scale, right? So it's hard to get the size of a debt for nature swap to a level for individual country that can really make a difference to sustainability, because they are complex and challenging to structure. So scale is hard to achieve. That's one issue. Negotiations around debt for nature swaps, context of restructuring, where everybody's fighting over a piece of the pie already, can make them longer and more complex, and this can come with higher transactions costs and monitoring costs. Comparability of treatment, that's another arcane subject in the debt restructuring world, but if you incorporate debt for nature swap in a restructuring, it can complicate the issue of comparability of treatment, which is very important. So one thing that we would certainly recommend, and we've been discussing this in the Global Sovereign Roundtable, is that capacity building for governments when they're developing debt for nature swaps is important. I think we're seeing more interest, including from the private sector, in helping with design choices of debt for nature swaps to make them most effective. And of course, debt for nature swaps have credit ratings implications, and those vary across the big three ratings agencies. Not to get technical, but buybacks of this sort tend to be discount to par, so you've got financial losses for creditors by definition. So helping country avoid default can be seen as a distressed debt exchange, and that has implications for credit ratings, especially in event default. And it's even true with voluntary participation in these exchanges. So, bottom line, debt for nature swaps need to be carefully designed with careful cost-benefit analysis. And finally, just to wrap up with respect to credit ratings agencies, one that we've been working on at the IIED for many years, for decades, since the early 2000s, is the importance of stable capital flows and fair debt restructuring based on strong investor relations programs. And these can really enhance the dialogue between borrowing countries and their creditors, and importantly, the credit rating agencies. And I think what I was alluding to earlier about the GEMS database and the data gaps and so on, it often prevents credit ratings agencies from accurately assessing a country's economic situation. So it can make it harder for them to have accurate credit rating and regain market access in the post-default. So in other words, getting back to a market credit rating. A strong investor relations program can really help better inform both investors and rating agencies. You know, Annika mentioned spending trade-offs and the importance of ensuring that sustainable finance is not spent on non-sustainable purposes. And there were comments in the chat on the fight against corruption and so on. I would say, you know, sunlight is the best disinfectant here. So borrower creditor communication, investor relations programs, absolutely essential. And early engagement with credit rating agencies. I've just come off call with Moody's, Standard & Poor's, and Fitch in the Global Sovereign Debt Roundtable. They all said the same thing. Sometimes we are last to find out, we credit rating agencies, about an imminent situation of debt default. So early engagement is really strongly recommended. I think I'll stop there. There's more to say, but we've got a lot of questions, I'm sure, from the audience. So happy to field any.
Great, thanks very much, Sonja. And I think we had a couple of little glitches in your sound there, but the transcription, which was working at the time, that seems to have captured it very well. So if anybody has any bits that they didn't quite catch, please do take a look at the transcription. I think what we'll do now, given time, is we'll take some questions, and then we'll come back to the panelists with some sort of asking for their thoughts on what they've been hearing, what's some of the key things that we could be thinking about as priorities over the next sort of 6 months. As we said, we've got the spring meetings coming up, we've got financing for development, and there's a lot of global change happening, an understatement. How do we work together effectively to address those sorts of challenges? So coming to the questions, there's one that I would like to pick up and perhaps Jwala, ask you about this. You mentioned the role of reinsurance. Have you, what are your thoughts on the role that reinsurance might be able to play in these swaps, or around some of the challenges that particularly the SIDS are facing? Obviously, extreme weather events, hurricanes and so on do create real challenges for countries having to rebuild infrastructure. So potentially the role of reinsurance and swaps, but potentially the role of insurance more broadly. Thoughts on that would be great.
All right. Yeah. Thanks. Thanks, Laura. So as you've said, I mean, the climate events, the climate shocks, increasing and in intensity. We keep seeing that here in the Caribbean. As I mentioned, we have PRIF, which is a regional catastrophe risk facility that provides that sort of parametric insurance and payouts when some of these particular shocks hit. The issue is that PRIF itself has to reinsure its pool, and that means it has to now go outside of the region to get that to buy that sort of reinsurance. And those rates are rising also because one of the things we've seen is when the hurricanes pass through the Caribbean, they don't just stop in the Caribbean. They continue and they move into the coast, primarily Florida, Texas, right? That the Gulf of Mexico. And they move into that space. And then those are regions that are also being hit and contributing to the fact that reinsurance rates are going up. And I think it's one of the things that Caribbean heads of state have said that they need to look at then is, could we develop a regional reinsurance facility that really clearly, again, it would not provide all the reinsurance needs, but it could provide some. And we do have some really large insurance companies, indigenous insurance companies in the Caribbean that could play a role in this. We also have banks and private pension funds that sit on some really more longer term capital that needs a home. And therefore, what we see is that there is a pool of resources that are sitting idle that could be leveraged to at least deal with part of the reinsurance needs. But this is something that is in a exploratory stage at the moment. It hasn't moved really far, but I think it's critical. And then how do you then bring some of the larger international reinsurers into that picture? And even how could you then link that to some of the sort of work we see coming out from the MDBs, such as the World Bank, in terms of, let's say, catastrophe bonds and CAT DBOs. And therefore, it means really looking at, when you think of reinsurance as one part of that risk layering that is needed for countries to deal with debt and climate.
Great, thank you, Jwala. Mahmoud, would you like to come in on this?
Yeah, just to complement what Jwala just mentioned, there are a couple of things in practice. One, after the Paris Pact, and definitely with the Bridgetown Initiative, there is a great deal of emphasis on the prepaid arrangements and the role of insurance and the catastrophe clauses. We have a great history, positive and negative, on triggering these clauses. They are not new. They have been there. But the problem is that when you need them, especially at scale, those who are insuring you, and including those who are reinsuring the insurers, sometimes they get us into some problematic situations. And I think the last hit for the Caribbean countries had some countries missing the opportunity to activate what they perceived that is their right. So I think here matters related to transparency, issues related to technical collaboration, assistance, and trust between the different parties are very much important. There is a decent piece that was co-led by the former head of DFID and OCHA, Mark Lowcock, as a co-chair of that group or the commission. And I think there are lots of ideas, not just in issues related to the small islands, but basically about development finance, nature finance, and linking the whole thing to humanitarian finance. As I understood from my perspective from Annika's intervention, there is a great deal of pooling of all of these sources. Sometimes we, in the beneficiary side, we tend to put them in different compartments and different vehicles and all of that. But the sources of funds are pooled almost in one. So when a pocket gets more, it's a zero-sum game. So we need really to be careful as well on this issue of pooling, just to react to what Annika's mentioned. The other thing, and very quickly, there is a moral issue related to that, and I think not just from the Pope ethical perspective, but from Esther Duflo kind of calculations. And Jwala reminded me of his talk when he said, well, the exposure of many of our countries to adaptation costs, while their emissions are very much limited or even not to be realized as significant. So here, there is this issue of the moral debt and how can we settle it? It's difficult. You can calculate this issue, how much a country is emitting more than its fair share, and you calculate that by tons, as Esther Duflo did, and then you can say, well, as she made it last attempt was 2023, it was almost $450 billion. So this is basically what the advanced economies are owing to the developing economies if we follow her methodology. But basically here, those who are responsible for the emissions are not necessarily those who are creditors. So the issue about simple swaps are not there to apply easily. And the other thing, and the final point I mentioned to the important update that Sonja mentioned in the history, when they started to do this work in the IIF and the coordination, the landscape is different. So back in the year 2000, for instance, the creditors of the Paris Club, 40% of credit was Paris Club. Today, they are less than 10%. London Club is even less than what they used to be. And then you have the private creditors, China, and here this gets us again into the importance of the IIF and the other private sector creditors who are not really as organized as the IIF group of creditors are. So this is basically issue of coordination. And I think that piece by Hogan and Setzer is very much important about the acceleration of the work, the settlement of the credits, and the comparability of treatment that Sonja mentioned as well. So lots of good work, but we need to realize that we are not in 2000, we are not even for all of these developments, we are not even in December 2024 anymore. It's a completely different world that we're living in.
Thank you, Mahmoud. I think that's very clear that the challenges that we face are getting bigger, and often some of the lessons from previous can be brought forward, but actually we do need to sort of think differently. We've got sort of interesting questions in the chat. I can't think of ways to necessarily group them. There are some in there that are more about the swaps, but I'd like to just pick up one other issue, which is this sort of idea of, if we're going to bring in private finance, and I think, Annika, you mentioned this earlier, you know, we want to ensure that it is delivering on our sort of environmental and climate and development objectives. And we've got a question around the sort of standards for, you know, sort of, you know, financial reporting, the sort of things like the principles for responsible investment, the sustainability disclosure standards. Do you think they're sort of sufficient to drive finance to the sorts of things that we want to see being delivered more efficiently and more effectively?
I think that I don't know if it's sufficient, but I think in order to increase the interest in investing, of course, in all sorts of investments, but also in nature itself and natural resources. I mean, the sustainable use of natural resources. I think there is a lot of experience in many of you know, countries in Europe, for example. We've done a lot of bad things previously, but we have learned a lot by our mistakes and the costs that we now have of trying to address the negative effects of our development. So I think there is a lot that we can contribute with, but I think it's linked to a broader question, which is the whole question of finance or public finance management. That even we can, I mean, I think development cooperation can link up with the private sector and the financial institutions, both in our part of the world and in the partner countries. But I think it does require a couple of, you know, I think that need is increasing in the world that we now see been developing, and it is that the accountability, because it doesn't matter what sector you're in, doesn't matter whether you work for a financial institution or another, you know, private enterprise or a government. We need that accountability from the government at all different levels in any country. We also need to see that, I think that the income differences are actually decreasing. When we see that in some countries, not only that the same people that are governing the countries are putting in or increasing the debt burden of that country, sometimes for good reasons, but sometimes for bad reasons, and that there is a lack of transparency in how that investment and the loans are used in a specific country. I think that's, and if you then link it to that some of these countries also not only borrow money, funds to develop, but they also do it to develop, for example, the extraction of natural resources in a very in a negative way in terms of sustainability. So increasing the future debt, the future nature debt and climate debt to not only the country and its people, but also to the global world, which could be, you know, less interest to that specific country. But I think even though we know that there is a historic, of course, responsibility, and as you said, a moral responsibility from, for example, Europe to support anything which has to do with climate adaptation, climate mitigation, there is, I think there still is a need for all of us to think of sustainability, both in terms of how do we spend our funds in one specific context, and where does that money come from? Who is long-term gaining from those loans? Usually in some of the countries I've been working, I mean, neither the people in that country or the people in our country, they don't gain. It's people, it's the, you know, the middle people, and also, of course, government officials and politicians and private sector people in that same context. So, and I think that becomes increasingly difficult for us as development partners to excuse, because these people in many countries are super well educated. They've been to the best schools. They are very well off. So people in our country would say, they don't, but they could say, how come they spend so little tax money on their own, you know, the groups of people in their own countries that are really, much, worse off than most people in the world. And I think we need to be brave and have that discussion. I think it is linked to development effectiveness and ownership, responsibility. And I think that is a change that has taken place, that if you go back 20, 30 years, everybody would agree. Everybody in Sweden would also agree that we are obliged to, morally and historically, financially, we should support every other, all countries which are more in need than we are. And I think now the situation has changed of different reasons. I think both one is, of course, that we see increasing problems in our part of the world of different reasons. We also have the environment and the climate debt that we all need to pay now. And there is a huge pressure on investing in the sort of a green transition in our part of the world, which is, and this is also important, very complicated on a global market and in a world where other countries, which also work in our partner, the recipient countries, with investments and loans, but with a much less interest in human rights, environment, gender equality, for example. So I think we need therefore to link the funding and the investments and debt for nature swaps, whatever, to another dialogue, which is also based upon the fact that if these countries that we work with and in, if we all want to achieve sustainability, where we will decrease the future costs of not taking into account the climate change and environment and biodiversity loss, we all need to work together. Because otherwise, I think people, for example, in Europe, they will ask themselves, how come that, from our children from 20 years, 20 years in the future, why should they then continue paying for the same sort of nature debt that we now create, not only in our part of the world, but also support in other parts of the world? Well, not because we want to, but because we're not enough strict when it comes to what do we invest in. So, and at the same time, we all know that there will be no development if the government, which is responsible in the recipient countries, are willing to do that, an investment in sustainable development. I mean, so we need to be aligned. We need to secure ownership. But I think we can support that ownership by ensuring that the ownership is or does include people living out on the countryside or in the slums, also being, men, women, young, old people, and representing the society. And I think that is what we can support. We can support the inclusiveness perspective and then making sure that more people take part of a specific country's development and political priorities, and including where and how that country is borrowing from other parts of the world, because somebody will eventually have to pay it back. So of course, then if people know that, yes, we are borrowing money to invest in our future and in a sustainable development, and also in a decrease in the income gap between different groups, I think then people would be willing to, then it's fine to have that loan, but then you also have to make sure that there's a long-term responsibility and thinking when it comes to the interest rate. So otherwise we'll have the risk of defaulting countries, which is bad for everyone. Thank you.
And thank you, Annika. I think that sort of inclusion and accountability theme is very well made. We've just got a few minutes left, so I'd like to ask each of the panelists, and I see you've got your hand up, Sonja, so perhaps you can integrate your what you wanted to say into a sort of a final. What do you think are the sort of the key priorities over the sort of this 6-month period, spring meetings, financing for development? that we need to really be thinking about working together on to address these challenges. So I'll go quickly around the panel, and hopefully people will be able to just stay to hear those. But Sonja, over to you.
Do you hear me, Laura? Okay, great. I think you said yes. All right. I wanted to address two quick things, also in the context of what private sector can do to be supportive and what to look for in terms of outcomes it brings. And wanted to relate it to one of the two questions actually that came up in Q&A. One is on are current standards enough? You know, TCFD, the PRI, IFRS, and all that. And the other one around what private sector can do in terms of scaling blended finance, and the comments of Inmit Gill from the World Bank on billions to trillions of fantasy. And I think the two things are related. A disclosure point, which is everything we've been talking about on transparency more broadly. Sure, the standards are out there. There's plenty of them, and that in part is the problem. They're having such fragmentation around disclosure to do with climate and nature-related disclosures. So you have the hard-fought IFRS standards, now the International Sustainability Standards Board, the ISSB, that should be the global baseline. Challenge, the dilemma is in the implementation. Different countries are implementing at different rates, some not at all. It will remain voluntary in major areas, including the United States. So that creates difficulty with the global baseline. It's also the case that in some regions, and the EU specifically, there are further sustainability disclosure standards, whether at the EU rules level or in prudential regulation. So companies, financial institutions are left with a whole range of disclosures to comply with, and it makes it very difficult. And it's actually an effective barrier to scaling sustainable finance, this kind of continued dilemma with disclosure standards. With regard to the scaling blended finance question, the one thing I want to stress is that above all, what would be helpful here is having greater alignment between policy and regulation. The financial sector can do a great deal, but if the policy framework is not sufficient in a country to incentivize private finance, then all of the regulation in the world can't accomplish that. And I think this is a subject that's going to get considerable discussion, including over the course of the spring meetings. Thank you.
Thank you, Sonja. Jwala, can I ask you, and then Mahmoud?
Yeah, sure. A quick one. I just want to conclude my remarks around the debt swaps, which as the discussion started, I saw my good friend Yolanda actually provide some of the documents that Eurodad has done on debt swaps. Here's the thing: the debt swaps have helped to provide some level of debt service reduction for countries that have implemented them. The issue is that many of these swaps lack transparency, accountability, and inclusiveness. I mean, that's clear. If you look at the last the Galapagos debt swap that was done, you actually had civil society, local community groups having to file a complaint with the IDB related to the fact that monies were collected, but they weren't spent. So there's a whole issue around accountability regarding that particular swap. And civil society, particularly Rodad, has done some really good work on analyzing these swaps and coming up with their points of view. My view is that in and of themselves, a debt swap is a financial transaction. It's a capital market transaction, and therefore it means we need to look at what have been the specific drawbacks and issues associated with the last set of swaps and see how can we treat with those, how can we mitigate some of those concerns. And a key part to me of that is really at the start, including civil society groups in the planning, then in implementation, and then in monitoring. And one of the things we've seen in the Caribbean is that civil society engagement is actually very much alive when we look at nature-based solutions. Every single successful nature-based solution in the Caribbean has included local communities. And that has contributed, right, in a really strong way to success. So my thing would be simply, we need to engage local communities, we need to engage civil societies, we need to engage NGOs from the beginning. And therefore, we could help mitigate some of the issues and concerns associated with these sorts of capital market transactions, including debt swaps. Thanks.
Thank you, Jwala. Mahmoud, I know we're running a bit over, so
right. I'll be very brief in 90 seconds. Just reaction to the important points on the debt swaps. They were relying on everything that Jwala just mentioned, but they had actually good support from the credit enhancers. And these credit enhancers were dependent, some of them are on ODA, official development assistance. So I'll be mindful as well with this system approach to what extent those credit enhancers could be impacted by the changes. The second thing, which is basically, you can read it in the joint piece that Homi Kharas and myself did for Brookings on the 4 priorities for Seville. But actually, again, thinking in a kind of a system approach and trying to go there with managed expectations and trying to maximize the benefits, not necessarily ODA in this case, but how to get better partnerships, how to minimize the harm of the spillovers of tariff policies, industrial policies, and the likes. And how can we do better job in the partnerships, including at the regional level and the localized level with impact, in order to do what we should really be doing on optimizing finance for sustainable development. The regional dimension and the local dimension were not treated adequately well in the previous pieces on the frameworks. So this is the time really to do a better job on that one. And then good luck with all of these interesting measures that are technically feasible, but require a bit of political support, not exceptional political leadership for them to happen. But we need really to push as much as we can within this kind of complicated environment to minimize the harm. If we cannot bring the benefits of sustainable finance, trade cooperation, at least we need to minimize the harm. And looking forward to seeing you all during the spring meetings and in Seville. Thank you so much.
Thank you very much, Mahmoud. Annika, are you okay if we leave it there? Was there a last? Thank you. I'd really like to say a very big thank you to all of our panelists and to our audience for some really great questions. I think we've highlighted here that the importance of the challenges that we're facing, the need for collaborative action, and we have opportunities coming up, even in the challenging global environment over the next 6 months. So thank you all again. Thank you for listening, and we look forward to collaborating further with you in the future. Thank you.
Thank you. Bye.
Thank you.